You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Gold, crude oil, corn, soybeans, and more. With so many tradable products, the futures options market can be an intimidating place. How can you possibly keep track of the latest trading developments across so many different products? Don't worry, we've got you covered. Welcome to This Week in Futures Options, the program designed to help active futures options traders stay on top of this ever-changing marketplace. Each week, we'll break down the top trades, hot products, volatility explosions, and much more. This Week in Futures Options streams live every Friday at 1:30 p.m. Central, so be sure to check out our live stream via the Mixlr app. That's MIXLR. Or join our live chat room at mixlr.com/options-insider. Whether you're an experienced veteran or a newcomer looking to separate the wheat from the lean hogs, This Week in Futures Options has the information you can't find anywhere else. This Week in Futures Options is brought to you by QuickStrike, options pricing and analysis software. QuickStrike offers powerful and flexible options analysis and pricing tools via an easy-to-use web-based interface. View prices on outright options or spreads with comprehensive page-level analysis controls. Build trades, manage risk, or explore historical volatility. QuickStrike has you covered, with market data reports ranging from open interest to the term structure of volatility. QuickStrike is the perfect addition to your trading toolkit. Learn more about QuickStrike at bantix.com. That's BANTIX.com. And don't forget to follow us on Twitter at QuickStrike1. That's QUIKSTRIKE1. This Week in Futures Options is also brought to you by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risks and seize opportunities. CME Group offers the deepest and most liquid options on futures across all asset classes, including interest rates, equity indexes, foreign exchange, energy, agriculture, and metals. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. This Week in Futures Options is also brought to you by FTSE Russell, a leading global provider of benchmarks, analytics, and data solutions. Investors in the U.S. and around the world are using FTSE Russell indexes to benchmark their investment performance and create investment funds, ETFs, structured products, and index-based derivatives. Many Options Insider Radio Network listeners will be familiar with the Russell 2000 Index. Russell 2000 futures and options are currently trading on the Chicago Board Options Exchange and CME Group. For more information, please visit ftserussell.com, cboe.com, and cmegroup.com. And now, get ready to break down the latest futures options trading activity. It's time for This Week in Futures Options.
All right, everybody. That music means it's time once again for TWIFO, This Week in Futures Options, the program where the name pretty much says it all. We look back at the week that was and still is from a futures options trading and trending and analysis and unusual activity and volatility and all of those fun perspectives. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-exciting network. You can always grab your TWIFO, get your TWIFO fix a whole bunch of different places. You can go to the website, theoptionsinsider.com. You can get the recent shows, go all the way back into the primordial ooze of the show there as well. You can also do that by the mobile app. Of course, you can always subscribe your iTunes, your Pocket Cast, your Google Podcasts, all that fun stuff. You can join us live. New time. Make sure you guys note that. It's been a couple of weeks now. It's Thursday, 1:30 p.m. Central. It used to be Friday. Now it's Thursday, 1:30. Same time, different day. So same bat time, different bat channel, I suppose. So 1:30 p.m. Central on Thursdays there. Join us there in the Mixlr live chat if you like. And, of course, that means the podcast comes out on Friday for all you podcast listeners out there, too. So you get it a day earlier. So it's kind of a win for all involved there. And, of course, however you listen live after the fact, make sure you do hit us up with those questions, those comments. We do love to hear from you guys. You guys send us in some very interesting directions with your questions. So keep them coming. We love to hear from you guys. And joining me on the old program today, let's start off with my cohort in all things futures options, the yin to my futures options yang. He is the founder of Bantix Technologies, creator of a little program we've used once or twice here on the show called Quick Strike. Mr. Nick Howard. Nick, welcome back to TWIFO on this fun Thursday edition of TWIFO. Sir, how you doing?
I already like the Thursdays better. I already feel free as a bird, knowing I don't have to be prepared for tomorrow at 1:30. So it's good.
We live to liberate you, sir. That's what we live for.
Yes.
Liberate next weekend. That's our motto here on the old show. And helping us do just that with a jam-packed Thursday show is our old friend. He hasn't been on in a while. Mr. Blu Putnam, the chief economist over there at CME Group. Blu, welcome back to TWIFO, sir.
Oh, thank you very much, Mark. Glad to be here. Exciting week coming.
Blu, you must have been licking your chops over the past couple of weeks. I can't imagine anything gets an economist more excited than a trade war. Am I correct?
99% of economists are free traders, so a trade war is really exciting for us to take a look at. We all have perspectives on it. It's great.
Exactly. It's just like more data, more ammunition for you guys. I mean, everyone pretty much learns Econ 101. The trade wars probably end badly, right? It's kind of one of the first things you learn. Once you learn the supply and demand graphs and things like marginal utility and things like that, you move on to things like, trade wars and tariffs and how they really are no winners. So this is a great teaching tool for you guys and nothing else, right, Blu?
Yeah, I mean, tariffs are basically taxes. So when you raise taxes, it's, you got to worry about these things, and markets have been bouncing around, some more than others. So it's been pretty exciting.
You're right. Let's get to all those markets that are bouncing around. By the way, Blu put together a huge report on all things trade war, on the impact on a variety of different complexes and products. You guys can find that, of course, at the hub for all things Blu and his research team over there at CME Group. By the way, of course, I should mention you guys can follow on not just live here on the show live stream, but of course at cmegroup.com/TWIFO. If you do that, you'll see the exact reports that Nick and Blu and I are going to be chatting about here on the show. We're going to kick things off in the land of Texas tea, so you guys should go into that report. See that little drop down there on the top left. Select energy, and then crude oil, and then WTI, and bam, you're good to go. I like to also change the expirations to include them all. If you do that, you see everything at once. It's a lot of data. Could be a bit overwhelming at first until you're used to it. But it's a lot of data. That way you can see everything at a clip. And if you do that and make sure your settings are set back to today so you can see exactly what we're looking at, you'll see exactly what we're seeing here. That kind of so far here on the week, it's kind of been it's been a topsy-turvy week here for all things Texas tea. Kind of dropping a bit yesterday on Wednesday with some information coming to the EIA that crude supplies, crude supplies is not an easy sentence to say. The crude supplies rose in surprise by 3.8 million barrels for the week ended the 27th of July. Of course, a lot of people who watch these things closely, and quite a few do, were expecting a much lower number, actually a decrease. So that, of course, sent us into a bit of a tizzy. And on the week right now, we're still kind of net, almost unched, up about half a handle, right around the 69 level out here in all things WTI. Vol also a bit of a mixed bag. We're seeing kind of the front couple of terms coming in aggressively. Again, the front couple of terms in the weeklies are really more gamma than vol. You get a little bit farther out, you start to see vol actually ticking up a little bit, which is showing maybe some interesting systemic things going on out there. There's been a lot to go on before we get into all the other options fun here. Mr. Blu, I know you've been paying a lot of attention here to crude in the wake of all things trade war. What's been catching your eye out there? I know a lot of the story has been WTI and indeed the spread with Brent WTI. So anything catching your eye? Any surprises going on for you out there?
Well, the interesting thing about the Brent WTI spread is you have to really understand where WTI connects with the rest of the world. And, we disconnected back in around, I guess, 2012, 2013 when the when the oil supply just boomed out of the United States and we overwhelmed our infrastructure, so the spread blew out. But now, the U.S. is an exporter of oil. We import a lot, but we export some too. And so the connection of WTI to Brent is actually on much sounder fundamental basis now. And one of the determining factors of that spread is actually shipping costs. So, what does it take to get a barrel of oil out of the Gulf of Mexico and Europe or China or wherever it wants to go? And that turns out to be it's a spread, but it's anywhere from like $5 to $8 or $9, and so that's really what's governing the Brent WTI spread now.
It's funny. I think a lot of people were thinking that these trade war issues would kind of put a near-term cap on that Brent WTI spread, kind of keep it a little bit contracted, maybe somewhere around that $6 range. And then what we've seen that for a little while there, of course, these Mideast tensions kind of coming in to exacerbate this. It's kind of been exactly the opposite. That spread kind of widened out pretty dramatically. It's getting a little bit tighter again, but still, has that been surprising you to you? Kind of the extent that the spread kind of widened out there.
Well, it got out to a little over $10 and then it came right back in, and that was. There was a bunch of things going on between, some ports in Libya closed, the ebb and flow of the U.S.-Iran sanctions issues and things like that popped it out. And then, and then the shippers came back in and people started moving the oil and the spread narrowed again. So, it works.
So Blu, see, first off, and I have to go on the record, I love having Blu on the show because I learn, I'm taking notes right now. I learn so much when he's on the show when I listen to him speak, so I really enjoy it. So one thing you could help me understand is, does any of this tariff talk have anything to do with that spread, flexing or contracting? I'm just curious.
It has a little bit to do, but not very much. Here's the issue. If the tariff war slows the Chinese economy, then they won't buy as much oil from the United States. But that's more on the overall price than it is on the spread. So it probably has a little impact on the spread, but it's more just the price of WTI getting moving up or down. So the trade war is in there, but it's not the big deal. The spread is much more about how these markets connect with each other.
Okay, perfect. See, I've learned something today. I'm always glad to listen.
That's why we bring Blu on. He educates us all here on the show.
And we did have we had a period there, where we were pumping out a lot more shale oil out of the Permian Basin, and it couldn't actually get to the Gulf of Mexico because it overwhelmed the pipeline. And that was also what went on a couple of weeks back months back when it hit that $10 or $11 spread. It was we had a little infrastructure bottleneck that's going to get solved and eventually. So, those things matter too, but that's not really a trade war thing.
Yeah, we had a kind of a weird confluence of events. We had, Middle East popping off again as is wont to do. We had, of course, you mentioned that kind of distribution bottleneck coming out of that pipeline there, and of course the trade war was kind of a trifecta of events that were contributing to that spread widening. It sounds like you're pretty optimistic that those production issues, because it got to the point, you're right, where they just could not. They could produce all the shale oil they wanted. They were at their max though for actually distributing. It sounds like you're pretty optimistic they're going to have that worked out pretty soon.
Well, I'm optimistic in the 2019 sense. There were a lot of people got way ahead of themselves forecasting the rise in U.S. production. And production has certainly been rising. But they forgot about it's not just as easy as, wow, oil is at $70. This is profitable. In addition to the pipeline constraints, they ran into sand. You put a lot of sand into the fracking process that goes down there, and so that was a little bottleneck. And so all these things work out, but they can take 6 to 9 months to work out. So 2019 is going to be the year that the U.S. probably hits 12 million barrels of production, which is that zone that puts it roughly the same as what Saudi Arabia can do, what Russia can do. It's going to be, it's really the big three now. You can forget about OPEC, forget about all these smaller countries. It's the big three.
Forget about OPEC. I like it. From Blu Putnam's mouth. Forget about OPEC. We don't need Nick. I guess you can cancel your OPEC watching tool. Blu says we don't need it anymore.
Well, you got to watch Saudi Arabia, but the smaller countries don't make nearly as much difference. They're stuck with listening to the big guys.
But you're right. It has been interesting to watch all that. And you're right. People got just extremely optimistic in their forecasts for U.S. production. We're going to be the biggest thing since sliced bread. We're going to outproduce everybody else combined, and all these other crazy notions. And we started to see some of those production bottlenecks and some of the other issues. We're also seeing, it's kind of interesting, Blue. I love having you on because we could, talk about a lot of different structural things that are going on in a lot of these products. And one of the things we're seeing a lot with crude these days, there are people, wagering or speculating or on this crazy, what they're terming a super spike. We're seeing other issues, people speaking to Congress saying kind of the long-term investment, because prices have been so low until recently, the long-term investment in infrastructure and in finding new sources isn't really there, and that could really contribute to much higher prices going down the road a little bit. Is that something that's concerning you in your research?
Well, we are looking at it. I mean, when you're talking, these long-term things are like 5-10 years down the road. What are you seeing in the 2020s as it develops? And a lot of the oil companies and those of us who follow these long-term things are looking at a big demand shift, and that's the continued improvement in efficiency of transportation vehicles, whether it's cars, trucks, jet planes, whatever. They're all getting more and more efficient every year. And as they get more efficient, that implies a drop in the demand for oil, because oil is 75%, give or take, used as a transportation fuel. So that's the big factor. And that's why some of the, if you look out at 5, 10, 15-year investment plans for in the oil sector, even with low prices, people are, these companies are taking a look at natural gas because it's a diversifier from the transportation sector. So, the crystal ball is kind of fuzzy, but those are the kind of things we're looking at.
It's interesting here. Let's speaking of things we're looking at the Quick Strike report here, and it's got a lot of interesting data for us, including here what's hot this week from an options perspective. And if you're looking out here, we talked a lot in the past. We talked to Blue about this topic as well. So yet again, it's not the weeklies that are lighting it up out here in WTI this week. It was indeed the SEP contract, the front month contract. The 73 calls, actually, we're settling out the week here right around, coming into the show here, at least not the week, but the show, right around the 69 handle. So these are about 4 handle out of the money calls in September, with about nearly 15,000 on the tape so far this week, taking our number one spot. The lion's share actually coming today. About 6,000 of those contracts lighting it up today. So obviously OI number is going to be a little bit suspect there. But so far for the earlier part of the week, opening about nearly 4,000 contracts. So opening upside paper here, taking off the top of our list. Number 2, actually, though, don't get too excited, all you bulls out there. Number 2 were the 67 puts, also in September, with about 12,000 contracts. The lion's share coming yesterday, about 4,000 yesterday, 3,700 or so on the tape today. The rest kind of scattered throughout the week, slightly closing, about 1,000 or so contracts closing it out down there. Number 3, the 72 calls, a nice little upside call strip. Again, all this paper, about 50% of the paper this week come in SEP. OI actually net on the week so far only up slightly, about 2.6%. So not a boom week for OI in WTI. Number 3, the 72 calls, about 11,000 and change. The lion's share again today, 5,300. So today's a little bit of reversal, perhaps driving a lot of call paper here. Number 4, what we got here? We got the 76 calls. So looking very optimistic here, with about 10,000 hitting the tape, pretty much evenly split between yesterday and today. Unless you think it is all upside calls all the time, we're going to go out really quickly. Right about let's say number 6. I don't think it's quite number 5. Number 6 in our top 5. So right outside the top 5, we got the June 2019 40 puts lighting it up on Monday. 8,270 of those going up. Actually closing, about half of that closing on Monday. Perhaps looks like maybe a 40-45 put spread going up on a ratio. We got the 45 puts also going up on Monday as well. About 4,500 of those and 8,200 of the 40 puts. So maybe a bit of a funky, not quite 2-to-1 ratio, but close to it, put spread going up. Slightly closing on the 45 puts as well. Mr. Nick, did you happen to notice those funky SEP puts? Is that up there in the blocks? Was there indeed a 1x2 put spread going up there? And then anything else catching your eye out here in terms of crude vol or skew this week, sir? Uh-oh. He has self-muted. Sir, are you there?
Yep. I was more looking at the 73 strike because I was curious. the September, which only has 14 days to expiration, that's quite a bit of new open interest in the upside calls. So that really caught my eye more than anything else. When you see, some of the users won't be able to click and see this, but you have 73, 72, 76, with an increase of almost 10,000 OI in those strikes, and you can go on further. So, very surprising, given that that's a 14-day option now. And again, that's why I was looking to see if there was people were rolling thing or financing some near-term calls with some upside sales. It looks like there was some 72.82 call spreads going on as well. So, so that's some odd stuff in a short-term contract like that. So I'll have to take a closer look and see about the puts when I get a chance. But as far as the volatility goes, I mean, you mentioned a lot of it off in the weeklies, but again, those don't count anymore. Once we get sort of inside of the 10-day, we start to look at stuff a little bit differently, not so much from a volatility standpoint. But one positive on the weekly that I think is worth mentioning is that there's quite a bit of trade today, 4,000 contracts in that week one contract. The open interest coming into today was 6,300, which an increase over the week of was 30 of almost 150%. So as much as they're still small in terms of the overall OI, I still like seeing those weeklies, because we talk about it all the time in Blue. We're always talking about the weeklies and lamenting why there's not enough activity. I think part of it is a marketing thing. Part of it is market maker unwillingness, and part of it is just people not, because the symbols are different, that it's not always necessarily very easy to see those as part of the regular series of contracts that are available to trade. But that's a good sign in general. But I mean, overall, in the meat of the contracts where a lot of the activities is happening, some slight gains in volatility. Further out, like you mentioned, a little bit more increase, which is always sort of something to keep an eye on. That means we get a little bit more steepening. We got a steepening of the vol term structure, so that's something to consider as well. So, kind of, maybe some of this change in OI is people rolling out into the later dated stuff, and I'll take a closer look at that and see if I notice anything with contracts being rolled out from the front to the back. I see a lot of SEP 9 contracts in today's block. But I can't give a definitive answer on that. But otherwise, from a volatility standpoint, if we look at the quick skew, and again, quick skew is our way of looking at sort of an agnostic viewpoint on skew, instead of looking at just a risk reversal, which just looks at the two volatility numbers. Quick skew looks at the volatility numbers in relationship to that, the money volatilities. And what we see is the puts kind of stayed steady, but the calls got a little firmer. So maybe we saw a lot of this upside activity. We see the quick skew in general across the board. Again, in this first 6, 7, 8 months worth of contracts, the calls are a little bit less cheap than they were. So maybe people are moving to see this little bit of consolidation and starting to think that we have some upside coming soon. Again, like we always say, the range has been the range for quite a bit of time. We've seen some good intraday moves, but nothing that's really shown us that a breakout's going to occur right now, except some of this call buying. So we'll have to keep an eye on that call buying as we move forward.
Since we're talking upside, let's roll right along here into equities. It has been kind of a fascinating, kind of surprising to me, probably surprising to you as well and your research team there, Blue. What we've seen, pre and post trade war when it comes to broad equity market levels as well as volatility. It seems like everyone and their mother was selling equities on the rumor of the trade war coming for a while, and then once we got the actual fact. The actual trade war officially kicked off close to a month ago now, 3 weeks and change or so. We've got pretty much nonstop bull runs. Of course, the last week coming into earnings has been a little bit different. We've seen some topsy-turvy results from some big companies. That's driven a little bit of a sell-off. But outside of the micro events, the macro trend has been north, and vol has come in. I noticed you also noted in your research there, Blu, another trend we've been talking about a lot on the show here, is that there's been a huge flight into small cap, things like Russell 2000, dramatically outperforming large cap like S&P post-trade war, as those kind of small caps are somewhat insulated from the effects of all this kind of macro madness. A lot of people see it as. So has it been surprising to you first, Blu, what we've seen post kickoff of the trade war, that, volatility has somewhat come in last couple of sessions last week, notwithstanding. Volatility has come in. We've seen pretty much a nonstop rally in the equities post trade war. Did that come as a surprise to you as well?
No, it's not that much of a surprise, because when a trade war starts like this one did, and you get this tit for tat retaliation, you immediately go back to the only example we all know of trade wars, and we go back to the Great Depression. Wow, that was really bad, and Smoot-Hawley tariffs, and it was terrible, and Senator Smoot and Congressman Hawley both lost, by the way, in their next elections, and you think depression, but anyway, that's really a huge overstatement. There was so much other things going on in that 1930s period. I mean, the trade war, the tariffs weren't good, but they weren't responsible for the depression. And if you start looking at what's happening with this kind of tit-for-tat tariff retaliation, it's mostly company-specific. China, Mexico, Canada, Europe, they're looking at products that they think can hurt the U.S. politically. They're not in it for the money. They're just trying to, play the politics on this. And if you're a company that happened to be in their sights, then you're going to get hit. But the overall impact on the global economy is not that large. It's negative, but it's not huge. The overall impact on the U.S. economy is not that large. And so with profits strong and earnings are fine, the index can go up. And, of course, what you mentioned with the Russell 2000 and, the small caps, is that most, let me start the other way, about 40% of the cash flow of large companies, they're multinational. It comes from overseas. Whereas small caps, specific ones may have a huge overseas business, but the index as a whole is much more of a domestic index. And so that's why, for 2018, during this tariff war, we see the Russell 2000 on net has been outperforming the S&P. Now that would change if the tariff war went away. It revert, and the large caps would then take off again. So, there's two sides to this one.
Yeah, it's been an interesting thing to watch. Equity volatility is always a turbulent thing. It's interesting to see how things like earnings season fades and plays into that stuff as well. We have the news today. Apple, a key component of the large cap, the largest of the large caps, now breaking the $1 trillion market cap level for the first time ever. So crazy things afoot there in the land of equities. Just look really quick here because, of course, we talked about volatility. We're seeing that discrepancy starting to widen out again. We mentioned the Russell 2000 outperforming from an index level. Also, obviously, small caps are inherently more volatile than large caps, so we see that spread kind of widening out again this week between the VIX, which is a little bit shy of 13, about 1290, and RVX, which is the Russell VIX, which is about 1570 or so, right, a little bit shy of 3 handle, about 2.8. So that's widened out substantially from last week, about a full handle or so, as it got a little bit tighter there last week. Let's look here, of course, as well. A lot of you guys like to sling the E-mini out there, the E-mini S&P, and see what's been lighting it up out there. Again, quick strike, click on the indices section, and you'll be able to find equity indices and click on E-mini S&P. You can see exactly what we're following along here with. And as we're coming into the show, right around slight rally out there in the large caps, at least 28 quarter or so coming into the show here. And we're seeing, again, the weeklies are kind of all the story out here in equities. By the way, equity open interest in the E-minis upsized this week, up nearly 10%, 9.5%. So a very strong week for overall equities. And the 2,800 puts dominate in the conversation this week in the weekly. So front week going away pretty much tomorrow. So near-term downside puts, Mr. Nick. That's kind of where the conversation is this week. Does that come as a surprise to you, or maybe given the fact that we're seeing a lot of topsy-turviness in this post-earnings in the middle of this earnings season. Does that near-term put love not surprise you at all, Nick? Oh, no, he's so aggressive with his mute, which I appreciate. You're very diligent.
I appreciate
your diligence.
I've been trying to be aware of wanting to jump in when I want to, but also not making sure that I'm not interrupting when I'm not supposed to. I think because we tested, I think on the open we started to test. We had a little bit of a softness in the index, so I believe a lot of that probably had something to do with trying to take advantage of the fact that we might see continued slide on the downside. I was watching it been watching the equity market a little bit more lately. I was watching, and we did look a little bit soft right on the open, and then a little bit longer. So, or pre-open, and then as we got in, it firmed up. Once it opened, it kind of traded sideways a little bit, then it firmed up, and we've seen nothing but upside since then. So probably had something to do with that. And, that's why those weeklies are so valuable. People are either trying to take advantage of a short-term move down, or, again, like we see so often in equities, they're trying to, sell them when they can, when the volatility is high, thinking that they're just going to continue to make money for them. So, no, my surprise, not necessarily, because as they approach the money, they're going to be a little bit meatier if you're a seller, and available if you're a buyer, thinking you're going to continue to go down. So no, and again, that's just me observing as I sit at my desk and not paying attention to anybody talking about anything or being on the being in touch with anybody. But that would be my guess. As far as other interesting stuff from the skew and the volatility standpoint, we see mostly red in terms of the volatility, but that red is small, so we're not seeing too much of a decrease. And as we kind of stay in a range, we're going to see the volatility get a little bit softer, but nothing that's really earth-shattering there. And then as far as the skew goes, one thing that I am noticing, and again, I'm trying to look at it from a short, when you pull up all the weeklies and stuff, I think you get, no pun intended, you get a little bit of a skewed perspective on skew, because it's going to naturally get squeezed as you move towards expiration. But if I pull off some of this early dated stuff, we see that we saw the puts get a little less rich and the calls get a little less cheap. So a little bit of a tilting of that curve. And we haven't seen that too much lately. So, and I'm talking from like inside of 90 days forward. So 90 days to 30 days, we saw the puts get offered a little bit and the calls get bid. So still a skew, still put skew. But that's probably the biggest thing that I noticed, and we're gonna have to look at that from a historical channel standpoint. So it's pushing it down quite a bit. So that's something to keep an eye on here as we, and again, when you look at it, it's always that way, but this is the biggest move we've seen in a little while.
Yeah, we're talking E-minis. Really quickly looking here, too, at the E-mini Russell 2000. It's been a banging week out there. OI up 13%. And again, it's actually a more bearish narrative and longer-term narrative playing out. We talked about weekly kind of near at-the-money puts in the E-mini S&P. In the Russell 2000, it's Dees 2018 1510 puts. Those are about 170-odd handles out of the money there. So longer-term bears kind of lighting it up out here in the equities. And just bears in general, which is kind of interesting. Again, maybe playing in, we have seen kind of a weird mixed, Blue, this must be an interesting time for your team as well, because we're seeing a lot of, I guess you can call it almost trifurcated markets at this point. We have many days where the Dow's doing one thing, the Nasdaq's doing something else completely different, and the S&P's doing something else completely different. And then you throw in the Russell, it's doing its own thing over there as well. We don't usually we see them moving in somewhat of lockstep. So has that been a fascinating, maybe post-trade war development for you guys to sink your teeth into over there on the research team?
Yeah, it really has opened up a lot of opportunities to look at the difference in these indexes. I mean, NASDAQ is effectively big cap tech, okay? So if something happens to big capitalization technology companies, that's going to be a NASDAQ story. The S&P is a much more broader market of large companies. Obviously, the Russell 2000 is a hugely broad market of small companies. And then you have the Dow, The Dow's only 30 companies, and it's price weighted. So companies that have high prices for their stock actually have an outsized impact. And there happens to be an airplane company that fits that qualification, and it's in the middle of the trade war. So, these indexes do move very differently in this particular environment because it's not an earnings driven. It's a very company specific. And if it happens to a tech company, it's a NASDAQ story. If it's a trade war story, it's going to hit the Dow, or the Russell 2000 may outperform. So it's a fascinating market, and you have to be very much into the company analysis more than usual. And of course, I'm a macroeconomist, so it gets a little out of my wheelhouse, but I'm having fun with it.
Things are out of my wheelhouse. It used to be the ags. I'm becoming much more fluent in the ags particularly over the course of the last 6 months. The ags have become just a much more dominant story these days on TWIFO, and indeed just in the broad headlines, of course. If you've been watching anything trade war related, listeners, you know that soybeans are kind of at the heart. They're at the crux of a lot of the issues here, and they've felt most of the impact, selling off from well over 1,000 down to south of the 800 handle. Coming in this week, we've seen a little bit of a rebound off those lows down. I believe they might have broke the 800 level. I'll have to go check it. It's the exact low out there in the beans. Coming into today and this week, we're up about 10 handles, and we're threatening to get back into the 900 level again, 890 or so coming into today. So maybe at least in the near term, the worst is somewhat over. We talked a lot, of course, as well about a lot of international customers. At a certain point, the U.S. beans are just too cheap. Why would you not buy those versus Venezuela or some of the other big exporters of soybeans? So at a certain point, the price was just too attractive. It kind of had to rebound there as well. So seeing a lot of that playing out there as well. I know, Blu, you've been pretty focused on the ags over there with your team as well. It's kind of hard not to be. It's really kind of ground zero for all things trade wars. I don't know how you could avoid it. Has it been surprising to you just how beaten down the soybeans got? And then, of course, this kind of little bit of a near-term rally we're seeing out here as well. Has this been surprising to you guys, or did you expect this dramatic move out here in the beans?
Well, I think most people that were paying any attention to the trade war knew that if China retaliated, it was going to be on soybeans. China has a huge demand for chicken and pork in their diets, and those two, chickens and hogs, basically only eat soybean. I mean, that's chicken. Basically, it takes about 9 weeks to mature. You think of them as they're a two-legged soybean, and so. You knew soybeans were going to get hit, but they got hit pretty hard, down 20% or so in price from their peaks, and that was a pretty hard hit. The other thing about soybeans that you have to remember is that, like you mentioned there, they're competitors for soybean exports. So you can go to Latin America and you can buy your soybeans there. That's not true of some of the other U.S. agricultural products. We're a big exporter of corn in the U.S., but we don't have as many global competitors. But in general, what we think the trade war impact has largely been absorbed by the market. We don't think there's going to be any more news on the trade war that's going to hit soybeans or corn or whatever. We think the next round that's going to be moving prices in the ag sector is weather, which of course would normally be the main thing anyway. And with El Nino returning, there's some issues in the wheat supply around the world, things like that. So we're bouncing off the bottoms that the trade war caused the downturn, and now we're getting some weather impact that may be bringing things back a little bit.
How did I know, Blu, you were coming on the show today and you were going to bring up your favorite topics in the world, El Nino and La Nina? I never met an economist, Blu, who was more excited by weather patterns than you. I think maybe you missed your calling. Do you think maybe meteorology should have been perhaps your home?
Well, as an economist, you get so many things wrong that you're naturally drawn to the weather forecasting business to, get some sympathy.
I like that. That's good.
I like that one too. Yeah. Well, Blu is the natural name for a weatherman too, right? The blue sky Putnam, right? So we're not always
right.
We're not always too far off. No,
well,
that's.
I grew up as go ahead.
Go ahead. No, sorry. You grew up as?
I grew up as a sailor, and sailors pay a lot of attention to the weather, so it's been in my blood for a long time.
So are those sayings actually true? Red at night, sailors delight. Red in morn, sailors take warn. Are those factual, or is that just made up?
Well, they're factual in the northern hemisphere, yes.
Okay, in the northern, right. Well, that's
I'm not sure about the southern hemisphere. That's why I qualified it. But yes, they work for me.
Okay, all right, that's good to know. See, I'm learning things outside of the markets. My notepad is getting filled up, but that's and I'm glad you mentioned. I actually saw your El Nino and La Nina presentation, and I got a great deal out of that because I always was sort of confused about how those two things or how the two weather patterns worked. But I think that's going to be really interesting for volatility when people start to realize just what you said, that sort of the noise has passed and the tree's been shaken in terms of the trade war, and now it's kind of back to the fundamentals. So it will be fun to watch what volatility does if we do get, say, a lot of rain somewhere, or the opposite. So maybe it's time to start paying attention to some upside plays here in the beans, especially if we think it's going to be wet.
Yeah, and you've also got Argentina actually had a little bit of a drought because of this La Nina pattern that just went away, and so they're going to get some rain. So their crop will be bigger, but other places around the world may turn out to be a little drier. I mean, it's not necessarily good news for Australia, for example, to see this pattern change. So, yeah, we're all going to be looking at this stuff pretty carefully, and I think there's some volatility coming from it.
Blu, since we're talking weather patterns here, I'm going to cheat. I'm going to bump up a question. We actually got it a while ago, and it just didn't seem suitable to our shows. But now that you're on, it's a perfect question to bump up. Comes from Robinar. They just want to know, real quick refresher, La Nina or El Nino, which one is good for the U.S. ags? I always forget. So there you go, Mr. Blu. Since I know it's your favorite topic anyway, you probably do the rest of the show just on this. But give us a quick, and give Robinar and the rest of our listeners a quick refresher on those two, and which one. I mean, they actually both can be bad and good, right? There's no real better. But
yeah, there's no right or wrong answer on which one does what. And they're both pretty global, too. So the El Nino is one of the more persistent impacts is it makes Australia more drought prone. The El Nino, which is the ones coming for the United States, it can be relatively benign for the corn, wheat, soybean crops in the U.S., and a lot depends on how the water in the northern Pacific off Canada and Washington State and stuff, whether that gets warm or not. And the last El Nino, that water did warm up, and that makes for a lot of moisture passing over the United States in the Corn Belt. That's not happening yet this time around, so it's a little bit of a wait and see. But the La Ninas historically have caused more volatility in ag prices, but we think that's shifting gears, that the El Nino is going to be the source of more volatility in the coming cycle. So if you're into volatility trading, I think El Nino is the one you're going to be focused on, and that's the one that's building right now.
There you go, ag ball heads. And all you ag heads out there, I know there are many of you. There you go. Breaking down El Nino versus La Nina for it. Really quick before we get off ags, it has been surprising on the one hand to watch the extent that the beans have been crushed. Corn got hit too, but as you point out in a lot of your graphs here on your charts and your research, that corn got hit, but nowhere near as much. And then we've seen other segments of that complex, like the livestock, not really take much of a drubbing at all. Has the selectivity of this impact kind of surprised you, Blu? Or, obviously we knew beans were kind of in the crosshairs, but the rest of the complex going, I wouldn't say unscathed, but less beaten up than we maybe expected or worried about?
Yeah, that's the difference in the trade war. The trade wars hit China pretty hard, and Chinese retaliation the biggest things they can retaliate on is airplane parts, car parts, and soybeans. But when you talk about the other ag products, you're really talking about the NAFTA debate. Mexico imports a lot of U.S. corn. They import U.S. hogs. They import U.S. cattle. And so Mexico would be the country. And, Mexico had a presidential election on July 1st. the candidate that won, I mean, he's basically, people describe him as being to the left, but he is quite pragmatic. And, the first thing he's done is reach out to, let's see if we can calm this trade war down because the uncertainty is hurting our businesses, and let's work this thing out. So Mexico has not been as aggressive at targeting some of the things that it could target. There was one day a couple of weeks ago where there was a rumor about them targeting hogs, and hogs took a dive, and then it came back. So, these hogs and cattle are on our radar screen, and corn as well, but it's much more of a NAFTA focus, and NAFTA for right now is not the one in the headlines.
No, but what is in the headlines, you're right, is also gold and all things shiny out there. It's been interesting to watch kind of the developments out there. People have been, waiting hopefully for the gold bugs out there. They are legion. They've been hoping for a return north of that 1,300 level. Haven't seen that this week. Excuse me. Selling off another 15 or so handles net on the week, right around the 12.15 level, coming in to showtime. So off about another 1.3%. or so. Again, vol creeping up again out here in gold, which, as we all know, it's kind of been a repeated narrative for a while here on the show, that gold vol can always use a nice little shot in the arm and getting a little bit of juice this week. We'll see if that's sustainable. So far, pretty much every time gold vol has increased this year, it's come in dramatically the subsequent weeks. So we'll see if this little pop is sustainable. Probably, spoiler alert, probably not, going by past his prologue, but we never know. I know Blu, I think still to this day, one of the best timed research reports we ever had on this network was when your colleague there, Eric Norland, came on with his gold volatility storm on the horizon paper and talking about how gold vol was at, around a 14 level was at that time about 5-year lows. And I think literally by the time we had the interview cut together and posted to our network a few days later, gold vol exploded. So he still has the award on our network for best timed research paper. I think he has that sitting in his office in London.
He probably does, and I'm guilty because I think I slowed down that research a day or two because I was like on holiday or something.
Well, that worked to his favor.
Otherwise, it would have been even more right.
It worked to his favor because by the time we talked about it, by the time we got out, it was just perfect. Couldn't have been planned any better. I think you guys.
Well, we obviously planned that stuff,
A little bit of collusion going on there.
Gold's an interesting thing. It's in a tug of war. It's the Fed versus global tensions. You buy gold for portfolio diversification when you're worried, and but gold doesn't bear any interest. And every time the Fed raises rates, that's a bullet that gold has to take. And so far the Fed is winning the tug of war over the political tensions, and gold's been on a downtrend. There's another thing going on in gold that most people aren't watching. The two largest buyers of gold jewelry are India and China. And what we're seeing is, China's decelerating a little bit because of the trade war, but India is fascinating. Half the population's under 30, and the millennials in India are not buying as much jewelry and gold as their parents did. So a little bit of slowdown in gold demand that we weren't necessarily expecting is kind of underlying this tug of war between the Fed and the trade war. So gold's another one of those fascinating stories with several different factors that aren't all that correlated operating at once.
Yeah, this sell-off this week not only driving a bit of a vol pop, not a huge bump in overall OI growth, only about 3% so far this week coming into today's show. So not a huge bump there. In terms of where people are lighting it up out here in gold land, number one with a bullet is still a bit of near-term bearishness, I should say. Front month SEP 1,200 puts, so the even $12 puts, slightly out of the money puts, about 15 hand out of the money puts, taking the number one spot with about 5,300 contracts coming into today's show. So near-term bullish, or I should say bearishness, still dominating. Number two, still though, there are some gold bugs on the horizon there with the OC 1,300 calls. So kind of even levels, 1,200 and 1,300. Nice little tight strangle or risk reversal there. Taking number two, 4,400 of those 1,300 calls. Lighting it up here on the tape. Actually, I take that back. There actually were about 5,300 of the $12 puts going up out here Oh, these are the SEP. This is the SEP. So, yes, those are the ones we saw before. I'm clicking around too fast for my own good here on the show, trying to squeeze in too many things into the end of the show. Speaking of squeezing in, we're getting up against it. Mr. Nick, anything catching your eye out here in shiny stuff before we move on into crude, or should be into crypto, sir?
Yeah, I wanted to follow up on one of Blue's comments. He had mentioned, a tug of war with the Fed. So as you raise rates, you diversify your portfolio with gold, all that stuff, and the rates go up. Gold's going to struggle with rates going up, and we just had the Fed meeting. It's something we didn't even talk about during the show. We, probably because it was a snoozer. Nothing much happened there. But if you start to look out in the Fed Watch tool, which is available cmegroup.com/FedWatch, you see that there was basically no chance of a tightening this last meeting from the first. But if you look at the September 26th meeting, you see that there's pretty much right now it's almost 94% chance of a quarter of basis point or 25 basis point tightening. And then if you look all the way to the December 19th meeting, we have it's a 67% of another 25 basis points. So if that's the case, and we see gold sort of sliding here, and if you see all the news wires coming across, the IAU ETF and gold itself are on 1 year lows. So if we see over the next 3 or 4 months that we have 2 more tightenings from the Fed, we could see continued softness in the gold market, meaning we very possibly get in the 1100 handle. And then I don't know if we get down to the test of the 1050 that we saw in late 2016, but definitely see us breaking 1200 if there starts to be some attention paid to the fact that expectation from the Fed is 2 more tightenings before the end of the year.
Yeah, I mean, the expectations are definitely in there by Fed guidance, if you will, for the tightening in September and December. By the way, it's easier to forecast the meetings that the Fed won't do anything. August, a summer vacation meeting, and the meeting in between September and December is November the 8th, 2 days after the election. They're just going to be sitting around like all of us talking about the election, so they're not going to do anything. But, you get those 2 rate hikes. Then the surprise that I'm looking at a possibility is 2019. There's some more rate hikes, that if you listen to the Fed, they might do some more in 2019. And I just don't think they're going to do it because by December, they will have flattened the yield curve. They'll be solidly into neutral territory on monetary policy. And I don't think we're going to have as strong a second half GDP-wise as we did in the first half. And so, the Fed could go on hold, and that could be your surprise that juices the gold bugs for the first time. You never know.
Do you see it pretty much in line for? Do you believe the Fed Watch tool at this point that we're going to see a couple before year end?
I believe September and December. That's my forecast, but I don't believe the 2019 probabilities.
Okay.
Oh, you can't see them in the Fed Watch tool, but they're in the Fed funds futures curve that there'll be some more rate hikes in 2019, and that's where I start to disagree with the consensus.
We'll add those dates, Blue, so the Fed Watch tool will reflect those as soon as we get those new dates in there.
You just roll forward a couple of meetings. So with one meeting out, you'll get another one in, and so we'll start to see those in the tool coming up. But what goes up often comes down, and as rates go up, I think the debate in 2019 is will they keep going up or will they in fact change and go down? And that'll be an interesting thing to look at. I know that Eric Norland and I have raised our probability of a 2020 recession. I mean, we still not sure it's going to happen, but it's getting to be a meaningful possibility now. And of course, if we were to see weakness in the economy, the Fed will drop rates. And by the way, when the rates go up at 25 increments, 25 basis points, but they don't come down that way. They come down faster.
Well, speaking of things that go up and must come down, that's why I love having you on the show, Blue, because you just tee me up for next segments. I'd be remiss if we didn't. I'm not going to have time for the questions today, listeners. Too much to get to, but we will have to get to really quickly. Another area that's gone up incredibly and then come right back down. We're talking crypto to wrap up the show here. Bitcoin futures over there at CME hovering right around 75.35 here coming into the end of the show. Should just drop down, 75.15 now, off about 30 handles or so. About 5,000 contracts on the tape again today. Remember, that's a big, meaty 5X multiplier multiplier. So a lot of contracts hitting the tape today. We talked about a new volume record last week. Not quite hitting that today, but still a lot of interest out there in the Bitcoin. Mr. Nick, I know you guys have been playing around behind the scenes with your Bitcoin tools offering. What do you got there at QuickStrike now for all the crypto fans out there?
Well, I think what caught my eye most interestingly, and we had it in there and I thought we didn't, and that's why I was kind of looking at it a little bit more closely. But if you look at the COT report for the Bitcoin, you can see that there were definitely a big increase in shorts from last report to this report. We'll get another report Friday, which will be up until Tuesday of this week, I believe. But for me, the more telling piece of the COT report was just the fact that the CME contract has pretty much beat the living daylights out of the SIBO contract, even though it's 5 times as big, a little bit more difficult to finance, all that kind of thing. But the OI, the positioning, all that stuff, the individuals with positions. So I think the winner here is CME when it comes to the crypto contract, and that's really the bigger news that I wanted to get across. That we talked to several companies about crypto feeds and stuff like that, and they're very active in getting back to us these days, because when it was hot, you couldn't get a call back, but now you get a lot of calls back saying, hey, are you guys still looking at doing our feed? So you really got to balance sort of, jumping on that wagon with what's happening in the market, and it's a little bit more tepid, but we're still optimistic that that's going to be good. And I think it's even more optimistic when you start to see the increase in OI and the activity and the number of holders in the Bitcoin contracts that the CME has available for trading. So that was the big thing that I noticed this week.
Yeah, you can get it in the QuickStrike COT tools, the Commitment of Trader tools listeners now. So for all of you who want that and all this love, it means the options got to be right around the corner, right, Nick? I mean, they got to be coming soon. That's what all these numbers here mean. But Blu, we've been talking trade war. We're all kind of trade war obsessed. You and your team are clearly, and rightfully so, trade war obsessed, because it's the big economic story right now. But have you guys had a chance to really sink your teeth into a lot of crypto yet, and any interesting research planned or maybe hot off the presses in the crypto space for you and your team?
Well, we kind of look at case studies to really understand what the fundamentals of the crypto space might actually be. So it's new to us in a lot of ways. But one of the interesting things we're looking at is the impact of things like electricity costs. You may not know, what does that have to do with crypto? Well, if you're mining cryptocurrencies, you need a bunch of servers, and you got to keep them cold. and that's electricity. And so what we've noticed is that when electricity prices go up, it makes the mining costs go up in the crypto space. So there's a lot of really interesting analysis to be done, but I have to say that personally I'm a novice on the crypto space.
Yeah, join the club there, Blu. We're getting there though, slowly and surely. We're all being dragged to the dark side of crypto. That music, it's hard to believe. That music means we're done. I can't believe it's already been an hour. Time flies when you're chatting with Mr. Blu over there and all of his in-depth research across. We didn't even get to all the products. We didn't even get to your questions. That's how much stuff was going on here to dive deep into on today's show. But before we go, let's go back around the horn. Let's start with our guest, Mr. Blu. We just talked about your crypto. Obviously, you guys are knee-deep in a lot of great trade war research. So what can we expect from you and your team coming out of the CME research department these days, Blu?
Our next batch of research is going to focus on risk-return probability distributions, because we think too many people draw them and they look like a bell curve. And so we've got a whole new proprietary set of ways of doing this that are going to pop out some much more skewed and every now and then very weird bimodal distributions when there's event risk. And we're pretty excited about this research giving us some insights into the riskiness and volatility of markets. So that's where we're headed.
There you go. Check out what Blu's working on, as well as his cohort there, Mr. Norland of Well-Timed Gold volatility fame, and all the rest of the team over there at CMEGroup.com. Click on the research tab. Usually Blue stuff and Eric's stuff is front and center. You can see it right there on the homepage. You click right through it because it's pretty good stuff, and people are interested, particularly these days when Econ 101 is suddenly back on the headlines every day. So go check it out, CMEGroup.com. Click on the research tab to begin your journey. And Mr. Nick, we just talked about all the upgrades you guys just made to the COT reports and the crypto stuff. You guys always have cool stuff coming down the pike, I should say, over there at QuickStrike. What do you got in store for us this week?
Well, there's lots of good tools that we've been sitting on, having them getting approved over at CME. So there'll be 3 or 4 new things that are available coming real soon, and those will be, economic data related, as well as that relation to that data to expirations, to be able to really very quickly see which options are best available for you to do your trading, to take advantage of things that are happening in the numbers market. There'll be some block trade alert stuff that's coming out real soon. I think people are going to find that very useful, especially the bigger places that actually pay attention to those that are happening. And then probably the biggest news, and we've talked about it over the last month, is we now have a version of our Quick Vol historical data available on both DataMine and within QuickStrike. So you have access to data from the beginning of 2007 to present, where you can get historical implied volatility curves, delta-based information, strike-based information. All that's available for a one low annual subscription. So check it out, send me a note, look us up on Twitter, so you can get a lot of data for very little cost per month. So all soon to be out there in every platform that we have.
There you go. Check it out. The easiest place to find it all in one place, bantix.com. That's BANTIX.com. Click on there. Click on the button there on the bottom there. So you want to check out free trial, a quick strike. You can see all the cool stuff we're talking about today and a lot more. Bantix.com to learn more. And last but not least, of course, he got called away at the last minute, couldn't join us. But our friends over there at FTSE Russell, they have all that data we're talking about today with, FTSE Russell versus the S&P and the vol differentials, all those things and a lot more. FTSERussell.com to learn more. And of course, while you're there, give them a follow over there on Twitter at FTSE Russell. All that data comes out in short 140, 280 character form as well. So you can check it out there at FTSE Russell to learn more. And on behalf of our friends at Russell and Mr. Nick and his team at QuickStrike and Blue and all the people over there at CME, and indeed myself, I want to thank all of you out there for downloading, streaming, subscribing, all the other fun stuff that you do. Keep those questions coming. Sorry we didn't get to them today. We'll get to more next week, I promise you. And we'll see you next time. Actually, I'll see you if you're listening live. I'll see you back in about half an hour for Option Block. Otherwise, I'll see you back here next week for more of This Week in Futures Options.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.